If you are the first person in your family trying to build wealth, you cannot afford shortcuts. Every shortcut has a longer route, and it costs you time. Time is the only variable that compounds, and once it is interrupted, it rarely resets cleanly. You are not just investing money, you are allocating decades. There is a pattern I call the shortcut decay model. It explains why short-term gain strategies often delay long-term wealth. The model is simple. Short-term strategies optimize for spikes. Long-term systems optimize for slope. Spikes look impressive, slopes build foundations. For first-generation wealth builders, structural survival matters more than temporary acceleration. Because you are not managing excess capital, you are building base capital. Daniel sits in his apartment in Nairobi. His phone lights up with messages. A friend doubled money on a crypto trade. Another flipped a property contract in 3 months. Charts move quickly. Screenshots circulate. Daniel feels the tension. He has $15,000 saved. It took 5 disciplined years. He wonders, should he accelerate? Should he take the shortcut? He opens his spreadsheet instead, not out of fear, out of responsibility. He knows volatility feels like opportunity. But he also knows instability can reset years of progress. Decades ago, a young investor sat quietly in Omaha studying businesses while markets fluctuated loudly. Before the reputation, before scale. Warren Buffett did not begin with dramatic trades. He began with discipline. Limited capital, long horizon, careful allocation. He avoided unnecessary speculation, not because he lacked courage, but because early capital is fragile. Different continent, different era, same structural phase. When capital is small, survival is strategy. Let's model this clearly. Two investors start with $10,000. Investor A pursues high volatility short-term gains. Some years plus 40%, other years minus 35%. Investor B compounds steadily at 8% annually. After 15 years, the volatile path may show impressive spikes. But frequent drawdowns reduce compounding efficiency. Because recovering from a 35% loss requires more than a 35% gain. It requires over 50% just to break even. Investor B's curve is less dramatic, but uninterrupted. And uninterrupted compounding builds structural growth. Here is the documentary truth. Volatility attracts attention. Consistency builds capital. Pause for a moment. Answer this question for some seconds. If you lose 30% of your portfolio in 1 year, what return do you need the following year just to recover? A 30%, B 35%, C 43%, D 60%. Take 5 seconds. 5, 4, 3, 2, 1. The correct answer is C, approximately 43%. Losses are mathematically heavier than gains. This is why volatility is not neutral. Let's proceed. If you want to understand how inflation quietly compounds against unstable strategies, I explored that structural risk in detail in a previous episode on inflation defense. This model connects directly to that framework, because erosion happens both through inflation and instability. First-generation wealth builders experience amplified pressure. You are visible, you represent upward movement. You feel urgency. When others post quick wins, restraint feels like stagnation. But short-term gains create psychological addiction. Each spike increases appetite. Each drop increases panic. And emotional swings interrupt systems. Family pressure compounds this. Lifestyle upgrades begin early. Expectations rise faster than capital. This is how short-term thinking destabilizes long-term architecture. Most people believe quick wins accelerate wealth. But structurally, quick wins often delay it, because volatility interrupts time. And time is the only force that compounds reliably. Quick wins are psychological noise, not wealth. Wealth is a controlled slope extended over decades. If you are building wealth from zero, your priority is not excitement. It is durability. You are not chasing spikes. You are engineering stability. You are not reacting to momentum. You are designing probability. First-generation wealth builders do not gamble with foundation capital. They protect the slope. They protect time. They protect structure. This episode introduces the shortcut decay model, but models require depth. In my book, I break down volatility recovery mathematics. capital fragility in early wealth stages, inflation-adjusted compounding models, structured allocation blueprints, psychological defense systems for long-term builders. The book is not a collection of motivational ideas. It is a complete wealth architecture manual. If this framework resonated with you, the next logical step is to study the full structural blueprint. Because isolated insights do not build durable capital, systems do. And to understand how volatility and inflation interact over decades, watch the previous breakdown on inflation defense. Then continue with the episode on time defense. This channel is not random content. It is a structured curriculum in first-generation wealth architecture. Quiet, disciplined, long-term. You are not here for noise. You are here for structure, and structure compounds. This channel is not about motivation. It is about transformation. Every video you watch here is one step closer to becoming the first millionaire in your family. Not through luck, not through hype, but through discipline, structure, and long-term thinking. We are building thinkers. We are building investors. We are building legacy creators, and if you stay here long enough, apply what you learn, and study the blueprint inside the first millionaire in your family. You won't just change your income, you'll change your bloodline. So if this video shifted your thinking even a little, subscribe, because this is not just content. This is preparation, and 10 years from now, you'll either look back and say, I started when it was small, or, I wish I did. Choose wisely. I'll see you in the next lesson.